Hello and welcome to today's live technical analysis. We're going to be starting off with the euro against the dollar. So, on in regards to financial news, we know that Fed Chair Powell spoke yesterday, but did not include any indications on monetary policy during his prepared remarks. Therefore, which is why you may be seeing the euro gaining slightly yesterday, but is moving in a downwards fashion today. In other news, China's CPI rates came in lower than expected, and as such, the Chinese consumer activity, the Chinese economy is now entering deflationary levels, which could push oil prices to lower ground. Now, starting off with oil, as you can see, it's testing support at 75.0, noting the wick on this bearish candle actually touching precisely on, or just below our 75 support level at S1, bounced off, perhaps a small market correction, despite breaking our downwards moving trend line, as you can see here, by extending this. We do not switch to a bullish outlook, simply a neutral outlook for the rest of the day, perhaps. Perhaps it was oversold. RSI near 30 implies a persistent bearish market sentiment remaining in the oil markets. Furthermore, the easing tensions in Israel appear to be driving oil prices lower, as well as gold. Let's just check for gold as well. Yes, also moving in a downwards fashion. So for oil, no need to currently change our support and resistance levels. We could, though, bring resistance at our one slightly lower, but this would be more of a temporary resistance level, 77.25. So this could be R1, and then we still have S1, S2, and S3. Note that the resistance levels are slightly closer than the support levels. Why? Well, if it does come back up for a small market correction, it could temporarily break above R1 before moving lower, taking out these, gaining some liquidity from the short orders, perhaps triggering their stop loss, and then moving below S1, potentially towards S2. Now, for a bullish outlook, it will have to break above R1 and R2. Simply breaking above R1 would not be sufficient. Why? Note the mid-range of the Bollinger Bands coming in between R1 and R2, so it could perhaps move in an upwards fashion from its current point up until the $78.26 mark, 78.20, let's say, coming back up, then moving lower. But this could be a temporary resistance level, which is why we've brought R3 down to R1, forming at 77.25. But overall, we're maintaining a bearish outlook for the commodity based on fundamentals and from a technical point of view. Despite the breaking, it does not necessarily mean a sideways fashion. As to why, the RSI indicator is not near 50. It's still at 30, implying a residual, well, not residual, a strong bearish market sentiment. So market correction higher before moving lower. So we have S1 75, S2 70.60, S3 66.15, R1 77.25, R2 80.10, and then R3 83.15. Now it simply jumps up and then it breaks above R2. You could place the next potential resistance level at this point, 89.20, what we consider R4, but this is not in play given that the price action is still below R2. If it breaks above, next target being our current R3, 83.15, and then perhaps 89.20, but far-fetched at this point in time. Moving back over to the euro against the dollar, we know that ECB President Lagarde is due to speak later on today. The comments made by ECB Vice President de Guindos may be slightly concerning in terms of he's reiterated that the bank is not in a discussion about cutting interest rates at this point in time, which is widely anticipated that interest rates will be at current levels for a prolonged period of time. What was interesting was his concern about the growth in the Eurozone economy that could potentially weigh on the euro and as such could result in a bearish outlook for the euro against the dollar. So weighing on the euro, allowing the dollar to gain. From a technical standpoint, you can see that it's broken above our upwards moving trend line and in fact has formed another upwards moving trend line, So the second being validated. Now, in theory, the formation of an upwards moving trend line could potentially facilitate a bullish outlook. But for us, that is not the case. Why? Despite breaking below our upwards moving trend line and forming an upwards moving trend line, the RSI is near 50 and it is at the mid range of the Bollinger Bands and it is validating that mid range at this point in time. Note that the Bollinger Bands as well, upper band and the lower band, are coinciding by adjusting our previous R1 to slightly lower ground, coinciding with S1 and R1. Therefore, sideways bias for now. We're going to have to readjust S2 to slightly lower ground, taking this previous lower low, previous higher low, under 1.05765 for S2. And then given that S2 new is too close to our previous S2, we'd have to readjust our support level for S3 slightly higher, slightly lower as well, 1.0495. So this would be S3, S1, S2, and S3. For now, a sideways bias between S1 and R1 for the reasons that we've mentioned before, based on the comments that, well, the potential comments from ECB President Lagarde could support or weigh on the euro. Therefore, up until her speech later on today, perhaps moving in a sideways fashion between the boundaries of S1 and R1, coinciding with RSI, so neutral market sentiment up until that speech. If it is a bullish outlook, so implying further rate hikes or worries about persistent inflationary pressures, we may see the market reaction moving higher, breaking above R1 and moving towards R2. Now, since we've removed our previous R1, we need to place our new resistance level for R3. We can take these candles at this point. So created a high, failed to break above and moved lower, coinciding with this order block here. So it came back up, tested, found resistance, and then moved lower. 1.0935 for R3. And there we go. So you have R1, R2, and R3. Then you have S1, S2, and S3. So as we've said, sideways up until ECB President Lagarde's speech later on today. For the British pound against the euro, against the US dollar, there are concerns that the UK economy has entered the recession. Now, a potential recession could potentially weigh and could likely weigh on the pound. So, despite gaining perhaps yesterday, gaining on today, weakening yesterday, small market correction, we could maintain a bearish outlook for the British pound against the US dollar. Now, by simply readjusting R1 slightly higher, 1.2305. Just readjusting from these, from the closing of this, from the open of this bearish candle and the closing of this bullish candle. We've moved it slightly higher to accommodate this wick, breaking below our upwards moving trend line. So bearish market sentiment is at the mid-range of the Bollinger Bands. Yes, it is at 50. So one could say perhaps a sideways fashion between S1 and R1. This could be a temporary support level, but it would be far too close to R1. So we're removing that. And since from a fundamental point of view, I would be maintaining a bearish outlook on the UK economy, given there are concerns that it may be in a recession based on reports from Bloomberg, but not being validated by the Bank of England and from data metrics. It's a bit of a concern. So perhaps a bearish outlook nonetheless for the UK economy, R1. For a bullish outlook, simply breaking above R1 and touching resistance at 1.2465 could constitute a bullish outlook. On the other hand, for a bearish outlook, breaking below S1 would be sufficient. Next target, 1.2065. Sideways fashion, failing to break above R1, moving lower to the mid-range of the Bollinger Bands, if not testing S1, failing to break below S1, and then moving in between S1 and R1. But personally, I think that the British pound may be moving in a downwards fashion. As you can see, 3 days in the reds, small market correction higher today, and then could continue in its downwards trajectory. I wouldn't place a downwards moving trend line yet, what we could see in theory could be another upwards moving trend line. It's broken below one upwards moving trend line, broken, and if it breaks below a second, if it breaks below the third, if a third is formed and it breaks below, then switching immediately to a bearish outlook. Dollar against the Japanese yen. So BOJ Governor Ueda's comments earlier on today hinted that the bank may be abandoning its ultra loose monetary policy, perhaps sooner than expected, even if there is no current increase in real wages. So what does that mean? The market appears to be not that concerned with these comments as it's continuing to move in an upwards fashion, validating our upwards moving trend line. Validated this one, moving higher. Wick, if it closes above, still validating our upwards moving trend line. It is fairly steep, yes, but nonetheless an upwards moving trend line. That's above the mid range of the Bollinger Bands, RSI near 70. So perhaps for today, we could maintain a bullish outlook for the for the US dollar against the Japanese yen, aiming for R1. If it breaks above R1, potential target being R2, 153. Now, based on the comments made by the BOJ governor, I think that he is easing the markets into the expectation that they will abandoning the rules reduced monetary policy. I think he's taking it in steps, and it's not going to be something radical. For example, if when he first took over, we saw a market reaction in a downwards fashion. Why? Many were anticipating perhaps an immediate switch, but that appears to have not been the case. So, what I think his game plan, quote unquote, would be is easing the market expectations of them abandoning the introduced monetary policy. If you're reiterating something over a long period of time, then the markets become accustomed to what could be perceived as slightly hawkish rhetoric. So, this could be an indication that markets have been accustomed to a slightly hawkish rhetoric from the BOJ, which is why it's moving in upwards fashion. So we could maintain a bullish outlook for this pair, dollar against the Japanese yen, for today and perhaps tomorrow. But from a more macro perspective, I would expect the Japanese yen to strengthen against the US dollar and move in a downwards fashion from a longer term perspective. Perhaps we may see huge movements in 2024, perhaps Q1 or even Q2. But for now, given that this is a daily technical analysis, we're maintaining a bullish outlook for the pair. For a sideways fashion, breaking below our upwards moving trend line and remaining between S1 and R1. For a bearish outlook, however, breaking simply below S1 would constitute for me as a switch from a bullish to a bearish outlook. The Aussie against the US dollar. So concerns about China could be weighing on the Australian dollar, currently testing support at 0.64. I would expect this to be broken today. So for a bearish outlook, breaking below S1 would constitute as a bearish outlook for me, aiming for 0.6285, perhaps for S2. And then lastly for S3, 0.6165 for the bears. It's also breaking below our upwards moving trend line, as you can see. We readjusted this to coincide with these two candles. Break below, open lower, therefore bearish outlook for this pair, weighed down by the fundamentals of China as well. And the RSI aiming towards 13, it's at 41, so one could say that it's close to 15. But based on the other indicators and from a fundamental point of view, I would be maintaining a bearish outlook and would be ignoring the RSI temporarily, although between 30 and 50 is still a slight bearish sentiment. So bearish for the Aussie. We're going to be moving to the US dollar against the Canadian dollar. So for the 4-hour time frame, moved higher, broke above R1. So you could say it's a bullish outlook. Now, the BOC's minutes came out yesterday. It appears to have not provided support for the Canadian dollar. Nope, as you can see, bullish candle on the daily time frame implies that the dollar gained against the Canadian dollar, so the loonie. What was interesting was that the fact that the bank did consider raising rates, and in their deliberations, they assumed that based on the tensions in the Middle East and in particular Israel, that oil prices would remain elevated or at current levels. As you can see from this chart, that appears to have not been the case. Oil prices are moving in a downwards fashion. Downwards moving trend line, simply breaking above, as we said, market correction. It was below 30, so this could be a market correction to R1, perhaps slightly between R1 and R2 before continuing its descent below the $75 mark. Now, if oil continues in its downward trajectory, as you can see, this was in August, it's broken below August levels. We saw tensions rising, oil prices, but then easing of volatility in the Middle East, facilitating the downwards fashion of oil. If oil continues on its current trajectory, I would not be surprised if the Bank of Canada adopts a more hawkish rhetoric. Therefore, in such an event, we may see the Canadian dollar gaining against the US dollar. But since we're looking at a smaller time frame, US1, support and resistance perhaps, but this would be more prudent to be S1, 1.3755, 1.360, 1.348, R1, slightly lower, 1.31, 1.3820. So given that the range between, actually we should bring up S2. You may be wondering, why are we readjusting? Well, as you can see, it's meeting some resistance at R1. This would be a temporary level. This would also be a temporary support level. Why? They're too close to each other, simply put, far too close. So for a bullish outlook, breaking above R1 and a clear break above R1. So breaking above this point as well. And as such, the pair might meet more significant resistance at R2 rather than at this previous point that we had noted. For a bearish outlook, breaking below S1 and aiming for S2 would constitute as a bearish outlook. For now, RSI is still above 50, but 56, so it's still close. Very tight. So this would be a very tight sideways moving channel, so it could easily be broken. But based on a fundamental point of view, I would expect perhaps the Canadian dollar to weaken unless we see more of a hawkish rhetoric emerging from the Bank of Canada. Temporarily, from a more macro perspective, I would be going perhaps more bullish on the Canadian dollar. Gold, 1,946, so that's RS1. RSI below 30, but relatively close. Strong bearish market sentiment for gold, formation of a downwards moving trend line perhaps as well. Much nicer. So downwards moving trend line below the mid-range of the Bollinger Bands in combination with the RSI would constitute as a bearish outlook for the precious metal. Currently testing support, 1,946. Potential next target for the bears being 1,915. On the other hand, for a bullish outlook, breaking above our upward moving trend line and R1, simply breaking above our upward moving trend line could constitute in a sideways fashion, whereas for a bullish outlook, it would need to break above R1. On the 15-minute time frame, let's just dive in. Validating support 1,946. 1 hour time frame as well, 4 hour, and on the daily, also validating. As you can see, broke below, liquidity, aiming for lower ground. But I prefer the 4 hour time frame, so bearish outlook for now for gold. The S&P 500 appears to be gaining, and that is slightly interesting because if the dollar is gaining, perhaps we may see the S&P 500 move in a downward direction. Why? If the dollar is strengthening, usually the S&P 500, Nasdaq 100, and Dow Jones 30, which are denominated in US dollars, might move to lower ground. But for now, that appears to not be the case. breaking above R1, readjusting. So this would be S1, 4,372. Why? Taking these previous lows as it broke above, simply readjusting, and then we'd have to bring S2 to slightly lower ground, because if I simply kept it at this point, you'd say it's very easily broken. Therefore, perhaps more significant support at the 4,225 level. And then for S3, perhaps taking these two previous lows, removing 3,980, so 4,065. And then for resistance, 4,452, which means we need to readjust our R1 and R2. Why am I bringing it closer and simply not leaving R2? Smaller market moves coinciding with the Bollinger Bands, so it's perhaps jury adjustment from our end. Previous high, 4,565, and then for R3, and this is on the daily, by the way, not a 4 hour. And actually, let me just show you why. This point here, let's zoom in. Coinciding with numerous bullish and bearish candles, found support, managed to break below and moved strongly below, implying that there is significant resistance at this point, 4,660. So this would be R3. So you have R1, R2, R3, S1, S2, S3. For now, perhaps maintaining a bullish outlook given that it broke above resistance turn support. RSI moving towards 70, implying bullish market sentiment. So we've done oil, we've done the Nasdaq, we've done the Dow Jones, S&P 500, oil, we've done majors as well. We can look at some stocks. For today, perhaps interesting would be, actually, we haven't done the Aussie. Well, we've done the Aussie, but what we haven't said is that the RBA's meeting minutes are due out tomorrow. So if they're slightly hawkish, could reverse this trajectory, move higher in tomorrow's Asian session. Whereas bearish, dropping below, actually moving towards S2 and then perhaps towards S3. So let's look at what might be interesting. Facebook, Lockheed Martin, Morgan Stanley. Morgan Stanley might be interesting. So we've cleared our chart. We're on the 4-hour time frame. This was a gap that appears to have been verified. Breakaway gap at this point. So let's just draw our rectangle here. Get it in yellow. And let's find our support and resistance levels. So am I picking Morgan Stanley? It appears that there have been some rumors circulating in regards to their wealth management fund, perhaps coming under scrutiny, which could potentially weigh on the company's stock price. So I'm taking S1, 74.55, breakaway gap, and opened at this point and then moved higher. So I expect there to be support at this point, validated by the opening of this bearish candle and the closing of this bearish candle as well. So support at S1. For S2, this could be a temporary S2 level, 73.40, but something that could be more significant would be coinciding these candles validated by the wick. We could be ignoring this candle. Let's just see why. If this opening coincides with the opening of this bullish candles, then it valid could be valid. You're seeing resistance broke above, came back below, potential support level at S1. Personally, though, I'd rather take 71.20. That means I am ignoring this strong bullish candle. But why? If you look at this point, there is more significant support than simply placing it at the most recent bullish block. I think if it does come back down, it might need more support at this point rather than slightly higher. Doesn't mean to say that it won't, but I think it's more likely to meet support here. As you can see by this wick, tested, managed to break above, moved higher. So support at 71.20. And then for S3, taking this previous low to the left around here. But I'd rather take this bullish candle. There seems to be more support and resistance respectively, fluctuating around this point. Probably validated by this wick as well. Validated by the wick of this bearish candle. Not ideal, but had I placed it higher, it would have been too close to S2. Therefore, I'll be keeping that level, 68.12 for S3. Now for resistance, you have R1, 77.90, heavy support, and then simply dropped, broke below. So support and resistance. Then R2, taking this previous low, then came back up to test, validating this as a resistance level. So it was support and resistance validated here. And then for R3, I'm ignoring this part of this bullish candle and I'm taking these three. I'll just take between, but that would be too close perhaps to R2. So I'll take it from where this bearish candle began, validated previously, 84.50.15. So you have S1, S2, S3, R1, R2, R3. This could have been an upwards moving trend line, but stopped, validated by a very strong move. Bullish, RSI, 60, so between 50 and 70, implying a bullish market sentiment. So it will depend on how much emphasis the market places on the recent scrutiny faced by Morgan Stanley. If it's insignificant, which it may appear to be, potentially moving in an upwards fashion, validating upwards moving trend line, testing resistance at 77.90 for our bullish outlook to continue, break above R1, aiming for R2. Bearish outlook, simply breaking below S1, would be sufficient for a bearish outlook. And let's just add the Bollinger Bands as well. Okay, still above the mid-range. Could be due a market correction lower, but time will tell. Goldman Sachs broke above R1. Actually, almost opened where we had our previous resistance level, which is resistance now turns support. So I have 317.55. Let's keep it's 290.50, but it's far too close. Very close. We had mentioned this previously. Could be trying to fill this gap that existed. We will see. But we need to readjust S2 nonetheless, taking this previous low, 304.40. It's close. So we'll give S3 some room, 289.40. Bearish outlook breaking below S1 and S2. Well, actually breaking below S1, switch and breaking below the mid range. So actually breaking below S1 and moving towards S2, if not testing S2 as well. But based on their side, which is 70, it appears to be a strong bullish market sentiment. You could say it may have broken our opportunity trend line. So there's a potential for a small market correction, but based on what we're seeing, bullish outlook for Goldman Sachs. I think the fact that they're returning to the roots is bullish for the company. They're sticking to what they know and what they're good at, which is wealth management for wealthy clients, selling off their retail lending business and essentially exiting that part of their business. I think is a good strategy, in my own personal opinion, as it appears to have been unprofitable for them. 352.70. Slightly more space for R2 and then for R3. Taking these candles, but it's too close to a bit too close to R2. So simply taking this previous high, 367.95. Bullish outlook for the company RSI. Upwards moving trend line may have been broken, but not considering at this point in time. So maintaining a bullish outlook for Goldman Sachs. Let's see Tesla. Perhaps the news that they've increased wages for their workers at their gigafactory in Berlin may be positive. It's still at 50 in terms of RSI, but an upwards moving trend line, and it's actually moving towards R1. Could constitute as a bullish outlook for the company, as it appears that they may be getting ahead of a potential unionization of their workers, and by doing so, they may prevent future strikes or perhaps more costs in terms of labor in the future if their workers were unionized at the gigafactory in Berlin. Therefore, perhaps bullish for the stock. Sociedad General, impressive drop. But let's see. Let's look at Amazon. We have some time, so let's look at. We've done Tesla. There's another chart we had. Portugal Commerce Bank. Note how Commerce Bank actually came back and touched S1 in terms of the wick that we had placed yesterday, 9.85. Found support, moved higher, even opened higher as well. And we keep support and resistance levels the same. Why? These are significant moves occurring in terms of the 1 hour and the 4 hour, which is what we were actually looking at yesterday. Touched, open higher, and these are significant moves in comparison to prior trading days as well. Therefore, maintaining S1, R1, R2, R3, and R3 respectively at the same points. Why? It's simply put far too volatile at this point to narrow our support and resistance levels. So what we had placed yesterday, which you can see at this point in time, remains valid. Bullish or bearish outlook, time will tell. One could argue this is an upwards moving trend line and that this is a second. If you take the wicks, perhaps. So this could be a more macro bullish sign. But based on this, moving between S1 and R1 for the next few days up until it evens out, and then we could compress our support and resistance levels to get a more clearer picture. Let's look at, we've done Tesla. Let's do UBS. Let's see, let's drop down. I've made time frame. I'd be aiming for this gap, the 30-minute, narrowing from the 1 hour, 4 hour. I think it may come back down to test this breakaway gap before moving higher. The other side appears to be slightly slumping, but it's still near 70. It's at 62, so between 50 and 70, implying, I'd say, a bullish market sentiment. So even if it does come down for a bearish outlook, it would need to break below S1 and then potentially move towards S2. For a bullish outlook, breaking above R1 and then aiming for R2. But we may have been slightly wrong with our resistance level at R1. Let's just bring it slightly closer, 25.15. 25.15, yes. R1, R2, and R3. Still maintaining a bullish outlook for UBS. Then we could do Apple. Since the last time we had placed support and resistance levels, broken above, resistance turned support, aiming for resistance 182.65. So we place new R3, previous high, give it some room to breathe as well. 196.15. Upwards moving trend line. So maintaining a bullish outlook for Apple. Let's remove our old S3. So I have R1, R2, R3, bullish outlook breaking above R1 and R2. R sign near 70, implying a strong bullish market sentiment, validated by our upwards moving trend line as well. And Amazon. Since the last time we had placed our support and resistance levels, it's broken above R1, R2. So let's just adjust. Let's remove these old blocks, I'd say. We actually have one more. Objects list, and then let's look for that rectangle. There we go. Gone. Resistance turn support. Resistance turn support. And then S3 would be brought higher, perhaps at this point where it jumped and moved higher, on 27.30, forming this breakaway gap. And then this is could be a breakaway, then continuation. Now, if this is an exhaustion gap, if it breaks below S1, I would switch to a bearish outlook. You have had breakaway, continuation. This might have been a final leg up before it moves to lower ground. So bearish outlook breaking below simply resistance turn support 139.08. 39.08. Then for S2, 133.27. And then for S3, 127.30. I will keep our previous support level as well, just in case we need it in the future. And then for resistance, I'll keep R1. And I need to find R2 and R3. That was probably a stock split. Right. So how are we going to measure our potential resistance level for R2 and R3? What we could do, we could take it in terms of size. So when I say size, 561, 561, actually nicely aligned. So simply put, reflecting this distance, 150, 150.50. Also big figure as well. Potential resistance. And then doing simply the same for R3. 156.10. So you have R3, which is now R1. 150.50 for R2. And then 156.10 for R3. Let's just change this text label. R1, R2, R3. Upwards moving trend line broken. Actually, this could have been a breakaway. Continuation and exhaustion. We may be seeing a reversal in the stock price of Amazon, but for that, I would like to see a breaking below S1, 139.08. And then I switch to a bearish outlook, as it may imply that this upward trend may have come to its end and that the stock may be due a market correction to lower ground. So keeping an eye out on Amazon, probably going to revisit it at some point in the future. Then Apple, for Tesla. Perhaps one more. Let's see. Sociedad General, Banco Santander. What have we not done? Majors. Stan Oil, Deutsche Bank. Certain dollar against the Japanese yen. Let's do Google. One final one. Delete, remove for our time frame on the daily, moving up, weekly. It's moving up on the daily. So for our last chart of the day, let's take S1, 130.15. And why? Well, opening of this bullish candle validated by the two wicks from the following bearish and bullish candle. So support level at S1, 132. You could use, I'll actually take 125.75 for S2, and then S3, 120.89. Let's just round it up to 90. S1, S2, and S3. Then for resistance, previous swing low, actually could be, from a short-term perspective, the first target could be 132.45. Probably might not meet significant resistance, but nonetheless could be a temporary resistance level. And then next, closing of this bearish candle, as well as here, 135 point. Let's see if we can put 136 and still validate those two candles. Yes, 136. And then lastly, R3, this high, 139.10. So for now, RSI aiming for 70, bullish outlook, upwards moving trend line as well, and a second one being formed. Bullish outlook for Google as well. And with that, that does it for today. Thank you for watching.
My name is Emily. Today we will look at what influences the price movements of major currency pairs. Currency pairs are influenced by geopolitical events, central banks' interest rate decisions, and macroeconomic data. For example, the Federal Reserve, the central bank of the US, maintains financial stability by increasing or decreasing the discount rate. The Fed sets target interest rates at which banks lend to each other overnight, but it also sets the discount rate, the interest rate at which banks can borrow from the central bank. If the Fed raises interest rates, it increases the cost of borrowing to slow down the economy. On the contrary, in order to stimulate the economy, the Fed lowers rates, making borrowing cheaper and encouraging spending on credit and investment. Economic releases such as major economies, CPI data, non-farm payrolls, gross domestic product, retail sales, purchasing managers, index, and others can influence the value of a currency and create volatility. Politics, trade wars, elections, corruption scandals, and changes in policies can create political tensions which can influence the forex market. For example, Brexit and British or American elections have been major events in recent years which have affected both the political and financial spheres. Traders who are new to forex trading tend to choose liquid currency pairs like the euro against the USD or the USD against the JPY. They also spend a significant time on researching and learning the forex market and the currency pairs they are interested in by analyzing technical charts and monitoring economic data. Choosing the right forex trading strategy, cultivating discipline, and eliminating emotion are also important. Depending on your schedule and lifestyle, you can also choose the right time to trade, which will also determine your trading. You can choose from swing trading, day trading, or scalping. Whatever currency pair you choose, or what style you decide to follow, ensure you have a solid education and learn as much as you can about the market you want to trade. Thank you so much for watching us, guys. Bye-bye.
Hey guys, welcome to IronFX webinar series, and today we'll be going through Fibonacci crash course. Okay, so if you guys have any questions while I'm going through, just feel free to type it in the chat box below, and I'll answer your questions straight away. All right, so let's begin. Okay, my name is Woon Hong, and I'm an investment analyst at Everest Fortune Trading Group. Okay, so we have a collaboration with IronFX, and this is for the webinar series. Okay, and this is the disclaimer as usual. Remember that everything in this video is educational in nature, and nothing should be construed as investment or trading advice. So please do your own due diligence before you guys trade, okay? All right, so the agenda for today, we have quite a few things to cover through, especially mainly focusing on Fibonacci retracement, extensions, projections, and expansions. Okay, so firstly, we'll be going through Fibonacci retracement essentials. Secondly, we'll be going through ideal market structure, significant swings following market trends. Thirdly, we'll be going through the different Fibonacci retracement levels. And second last, we'll be going through Fibonacci extensions, projections, and expansions. And lastly, the confluence levels that we should watch out for, and how can we combine these Fibonacci levels to show that there is Fibo confluence in here. Okay, so all right, so firstly, Fibo retracement essentials. So the checklist is very simple. We have 4 essential steps. Firstly will be, is the market structure clear enough? Look for big zigzags in the market. And secondly, identifying the recent trend. Prices going down or up. So is it a downtrend or is it an uptrend? Thirdly, to identify recent major swing lows and recent major swing highs. And the last one will be connecting the two extreme points, highest to lowest, which is a downtrend, and lowest to highest for uptrends. So what is the ideal market structure? So these are insignificant swings right here. These swing lows and swing highs are too insignificant, and they are not good to use for the Fibonacci points, because these swing lows and swing highs are too narrow, too small, right? And you are not able to draw it correctly. Sorry, you may be able to draw it correctly, but these points, for example, you draw from this low to maybe this high, is not efficient at all because these peaks are too small, right? And this is the second example whereby there is these are insignificant swings because again these swings are too narrow and price movement is too small. Okay, so let me just adjust. All right, okay, let's move on. Okay, so here is a correct example of significant swings. We have clear moves up and down and with obvious peaks and troughs. So these are the peaks are the highs right here, and the troughs are the swing lows right here. Okay, so we have a very clear market structure and movements. All right, so here is another example of significant swings. So I've drawn out the peaks and troughs to point out exactly how clear it should be, right? You can see right here, it looks like a triangle, right? So you can see right here, these are the swing highs, these are the swing lows, swing highs, swing lows, swing highs, and swing lows. Okay. Next, following market structure. So you can see right here, we have a very clear downward movement. Oh, sorry. Okay, then secondly, the Fibonacci retracement trend line follows the price movement. So if you're in a downtrend, right, you're drawing from the top to bottom. So these FIBs tend to work better on higher time frames. For example, your H1 and H4 time frames, because there are less noise. Less noise meaning there are lesser candlesticks, right, in the market. So your H4s are the ones that are more accurate. And we always say that high time frame is always king, right? Because it's more reliable in a sense. Okay. So this is what is wrong, in a sense that Fibonacci retracements should not cut through two large areas of the market structure. You can see right here, these lows connecting to these highs, you are cutting through this whole area right here, this whole down movement over here. So you should connect from these lows to these highs and not this one instead. Okay, you should not deviate too much from price movement. Okay, excuse me. Okay, so we have a clear market structure right here. We can see the highs, which are this, the peak right here, and then the lows will be this area right here, the peaks, the troughs, the peaks, and the troughs. Okay, so you can see very clear triangular looking patterns. So this is what we call unclear market structure, in a sense that price is ranging in this area right here, and there are too many narrow and small movements over here. And then suddenly we have a spike upwards and spike downwards. Okay, so these are irregular movements and it is unclear market structure, so you shouldn't trade pairs like this. So usually this only happens for like a exotic pairs such as maybe GBP, CAD, EUR, AUD, etc. Okay, so what are the different retracement levels? Okay, so we have, of course, in within the 100% and the 0%, we have our 23.6%, 38.2, 50, 61.8, 78.6. Okay, so oh, my screen is not showing. Oh, sorry, give me a, it should show. Oh, give me a second. Okay, is this better? Can you guys see my screen now? Okay, are you guys able to see my screen? Yes. Is visible now? Yes. Okay, so let me just go through again. Okay, so basically this is the checklist. All right. Just now I mentioned, is the market structure clear? And then we should identify recent trend prices going down or up, and then recent major swing lows and recent major swing highs and swing lows. Okay, then we can connect the two extreme points, highest to lowest, which is a downtrend, and or lowest to highest, which is an uptrend. Okay, then ideal market structure. So these are insignificant swings because the movements are too narrow. Okay, you cannot see significant swings. All right, so this is another example of a insignificant swing, because you can see right here the movements are too small and we don't have a spike upwards or downwards. Okay, so these are significant swings, right? A long rally upwards and a long drop downwards. Okay, so these are significant swing highs and lows. So you can see here the triangular patterns, right? Significant swing highs, swing highs, swing highs, swing lows. Okay. Then we should follow market structure, clear downward movement. So from the point 1 to point 2, you draw from the top to bottom, and you can see that the fib retracement trend line follows the price movement. It tends to work better on higher time frames, for example, H1 onwards. Okay. All right, so this is something that is wrong in a sense that fib retracement should not cut through two large areas of the market structure. You can see right here, it cuts through this whole downward movement, right? So you shouldn't draw from this low to this high. If you want to draw it, you can draw it from this low to this high. Okay, because when you are drawing fibs, it should not deviate too much from price movement. Okay. Also, This is a very clear market structure. You can see the highs, the lows, the highs, the lows. Okay. So what is an unclear market structure? You can see for this market structure is very messy. And this is, like you can see right here, is ranging in an uptrend, but it's making very small movements, very narrow movements. And we can only see maybe this swing high right here, but this movement is too close in a sense that there isn't a proper price movement here. It's just price spiking up, maybe because of news. Okay, then you can see right here, very small movements over here. Okay, so what are the what are the different retracement levels? So the different FIB retracement levels, all right, so 100% to 0%. So we can see that there is the 23.6, 38.2, 50, 61.8, 78.6. Okay, so your extremes are your expansion levels. So the negative 61.8, negative 27.2, and then we have your extension levels, 127.2 and 161.8 extension levels. Okay. So you can see right here, this is your range of FIB retracements from 0 to 100%. Okay, you can see your positive FIB retracements, which is greater than 100%. 127.2% is over here. And then the expansion levels are below the 0%. Okay. So what are FIBO extensions? Okay. So FIBO extensions are above the 100% level. All right. So what the two that are used would be 127.2 and 161.8%. All right, so you should always look for a Nike tick to find these very powerful setups. You can see a Nike tick right here. Okay, so once it goes past the 100% level, you should watch for reactions of the 127.2 and 161.8 in this GIF over here. Okay, starting point, you see ending point, Nike tick, right? All right, and then you are plotting, you can see you are plotting the FIB retracement tool. All right, then price actually reacted off the 127.2 first, and then it broke past and reacted to the 161.8. So you can see, right, very nicely reacting there and then going downwards. Okay, so you can see price reacted twice actually, and then came down and broke past all the way back to our midpoint. All right, so FIB extension levels. So this is example number 1. So you're drawing your starting point here and then your ending point here, right? And then price actually, see the Nike tick over here, price actually reacted here at the 161.8 FIB extension level, and then it reversed all the way down. Okay, so it's very important. Always look out for a V shape between point 1 and 2 and 3 when you are trying to use the 127 and 161.8 retracement levels. Okay, so this is example number 2. So example number 2, we can see right here, we are drawing this, we can see a peak over here, right? If you go down to maybe the lower time frame, okay, you can see this rejected wick over here. You can draw this 100% to your lows right here. And then we can see that price reacted off the 127.2% extension level, also because we have a major swing high over here. Okay, so price will always react. Just remember, price will always react to major key levels and then your retracement levels. Okay, so try to look out for your key levels first and then your retracement levels. Okay. All right, so just to zoom in, we can see right here that price reacted very nicely. Bodies all closing below the 127.2 extension level and then reversing downwards. Okay, then we can see right here, we are drawing from this low, right, to this high. And then we can see price actually broke through the 127.2 extension level and then came all the way down to the 161.8 extension level. So right here, you can see price reacted very nicely and is going to the upside right now. So the next one I'll be going through with you is expansions. Okay. So for expansions, Fibonacci expansions, right? So for Fibonacci expansions is less than the 0%. Okay, so the two expansion levels that we will take note of will be negative 27.2 and negative 61.8. So we should always look out for a flash zigzag when identifying these Fibo expansions. Okay, so one thing that we have to know is the clearer the movement of the zigzag, the better, and we ideally need to wait for prices to retrace at least 50% in 0.3. Okay, so at least 50%, right? Price coming down here, retracing 50%, and then before taking off in the other direction. So we are expecting a sell right here at the negative 27.2 expansion level. Okay, so the best situation would be that you are looking, let's say you enter a buy right here, and then you are buying all the way, looking for it to break here to go to the negative 27.2 expansion level, right? Then once price has very nice movement upwards, you can sell at the negative 27.2 expansion level. Okay, so we should watch out for the reaction of this level. You can see price tapped this negative 27.2 expansion level and then came all the way down. Okay. So the first example of the Fib expansion would be, so your starting point is here. Okay, and your ending point is this swing low right here. Okay, so price actually retraced up to the 61.8% level. So that's the criteria. So remember the criteria is to retrace at least 50%, right? So price retraced all the way to the 61.8% Fib level. And then what we're looking at is that price could come down to this negative 27.2 expansion level. Okay, so let's just see how it plays out. Okay, you can see right here, that price actually came down to this negative 27.2 expansion level and then bounced up really nicely from this area. Okay, there you can see that price usually comes back to the ending point, right? So your starting point, ending point, right? So it came back to this swing low support level, which because it was acting as a pullback resistance. Okay. So this is something that you can take note of. So maybe let's say you enter right here. Your first take profit could be at the ending point. And then if it breaks past, then your second take profit could be at the 23.6% Fib level right here. But since it really broke past and then reacted off here, this whole Fibonacci retracement will be taken out and this level cannot be used. So you should identify the next key level instead. Okay. All right. You can see. Okay, so you can see right here. Right, take note of the shape of the flash. So make sure, right, zigzag here, right, and then price has didn't close above this high, so it retraced at least more than 78.6% of the Fib, and then come down. Okay, so it broke past this low, so that's your second criteria. Broke past this low, then bouncing off this negative 27.2 expansion level. You can see right here, all the different wicks, price didn't even close below this negative 27.2 expansion level and flew up. Okay, so next, all right, so the fourth example. Okay, so in this GIF, take note of the shape outlined by the orange arrow. Okay, price retraces more than 50% of the Fibo trend line, and in this case, more than 100%, and reverses nicely off the negative 27.2 Fibo expansion level. Okay, so this is an exception whereby it actually retraced more than 100% of this Fibo trend line, came all the way back up and reacted off this negative 27.2 expansion level. Okay. All right. So what are Fibo projections? Okay, so very simple. Fibo projection should not be confused with Fibo retracement. Okay, so because Fibo projection uses 3 points, while Fibo retracement uses 2 points. All right, so Fibo projection percentage use will only be 61.8, 78.6, 100, and that's the max. Because 127.2%, 161.8, and 200% are only 127.2 is weak, can only be used as a supporting argument. While the 161.8M, 200% are more often used in Elliott waves and not such simple tools. Okay, you are usually looking for a flash zigzag, same thing in this type of Fibonacci retrace projections. All right, so you can see we have a 100% Fib projection right here. Price actually touched this area and then go up. So for Fib projections, you are taking the vertical distance from 0.1 to 0.2 and project it from 3 onwards. Okay, so 3 onwards, then here you're projecting it downwards. Okay. All right, so here's a simple example. You can see clearly the starting, the middle, right, and ending points follow the swing highs and lows of the price. Starting, middle, and ending. So this will be your start, your swing high, your swing low, your middle, and lastly, your last swing high will be your ending. So Fib trend line should follow price movement closely and should not deviate too much from the trend line itself. Okay. So you can see right here, starting, middle, and ending, right? So we project the Fibonacci as a extension right here. So if you're drawing from this swing high to this swing low and this swing high, right? You're projecting that price will come all the way down to this area. Okay, so the 78.6 Fib extension is a really strong level too. Okay, pro tip, always look out for big zigzags. Okay, the bigger the zigzag, the better in not necessarily have to be big, but it is more accurate in a sense that price will be more accurate. Okay, so for this one, we can see the price actually came down and touched this 78.6% Fib projection and then went all the way up. It is possible for you to trade this down move right before buying here, but it may be slightly riskier for those that are not too experienced because you may not know where the key levels are or like basic market structure, etc. So you should only enter a trade when you're confident and you know that this level is able to this level is the projected level that what's this Fibo projection is telling me. So I will enter right here. Okay. All right, so this is another example. So take note of this zigzag shape once again. So you can see this big, very, very big zigzag shape, right? So this time it is inverted, meaning that you're starting from the bottom to the top. And back to the bottom. Instead of top, bottom, top. This is bottom, top, and bottom. Okay, notice the clear movement in price structure, which our Fib projection trend line follows. We are projecting to reverse off the 100% Fib projection right here. And then let's see how it plays out, okay? So you can see right here, price actually reacted off the 100% Fib extension level and reverse all the way down. Okay, so when does a Fibo retracement become invalid? So one of the common scenarios of this is when price makes a lower low. So okay, lower low, And then assuming you are drawing a fib retracement from the top to the bottom, okay, if there are bars on the right that break your ending point, it becomes invalid. Okay, there are fib retracements that are negative, which I mentioned previously, negative 27.2 and negative 61.8. And we will touch on this as they basically go beyond your endpoint, yet they are still valid. Okay, you can see right here in this picture, this price actually broke this low, right? So it shows that price is now, so this fib cannot be used unless you are projecting a expansion level, right? But for expansion, because price didn't retrace back to 50%, then we cannot use the expansion. Okay, always remember to pick the lowest point with nothing on the end of your ending point. All right, so confluence levels. How can we combine your fib levels? Okay, so multiple fib retracement levels lining up together right here. And then you can see we have the negative 27.2 Fibo expansion level. So it's this movement down right here. And this could increase the probability of a bunch of fib retracement levels working versus a single fib retracement level working. So you can combine these fib retracement levels and you have your fib confluence levels. So that's why price actually bounced off the fib confluence area when there were 3 confluences in this part. Okay. Right here, this is the same. Okay, the third one will be your 61.8% fib projection and negative and 127.2 fib extension. Okay, so you can see right here, you project from this high to this low to this high, and then you can project that price could come to this 61.8% fib projection level. And then we also have the 127.2% fib extension level. Okay. All right, so same thing, but this one is kind of inverted. Okay, so you can see right here that if you draw from this high to this low, so your 100% will be right here, because there is your your 100% fib projection will be right here. And as for fib extension level, oh sorry, here, this circle area. So your fib extension level will be this negative 127.2% extension level. So while these two are working together, right, and this area right here, I will assume that there is a swing high on the left. That's why price actually make such a dump right here. Okay. All right, so we can see right here your negative 61.8% fib expansion and 161.8% fib extension. Okay, so negative here. And then negative, and then the 161.8% fib extension, because you can see price actually broke past the negative 27.2 and then followed by the 127.2%. Okay, so right here we have our projection level, right? Top, bottom, and top. So this shows Fibo confluence and then negative 27.2% expansion and 127.2% fib extension. All right, so trade management with Fibo confluence. So a stop loss beyond a key confluence area, price is attracted to such stop loss. Price is attracted to such strong areas of fib confluence. So if your stop loss is right here, right? Instead of buying, you will most likely get stopped out before the market reverses. Okay, so for your take profit, it will be for take profit, very simple. Take profit target before a key Fib confluence area. Because when price reaches the Fibonacci area, there's a high chance that you will not be able to go beyond it. And instead of reaching your profit target, it reverses back to even worse, your stop loss. Okay, so let me just go through with you guys. The charting itself. Okay, give me a second. Let me shift this out of the way. Okay, so what are we looking at? Let me look at this chart right here. All right, you can see price has already broken this 23.6% Fib retracement. Okay, then price could come down to a level. Wait, let me try and draw it. Give me a second. We can adjust this. Okay. Right. So we have a very nice shade over here. All right. So we can see previously price reacted off this 78.6% Fib retracement and 78.6% Fib projection, right? Not sure if you guys can see this. We just filter this out. Okay. Yeah, so you can see right here, once price comes back down again, right, I'm very inclined to buy. Okay, because buying off this area will be a good area since there is Fib confluence here, the 78.6 Fib retracement and 78.6 Fib projection. Okay, so let me see. Right about just now, let me see. We don't have. Hold on, guys. Let me. All right, so just now, okay, so right now, you can see we have the 61.8% feed projection and 78.6 feed retracement right here at the same level. So that's why I was inclined to take a buy at this block of this rectangular area over here. And then I was taking a buy, all right, did a quick 1.5% in a couple of minutes because there was G30 was moving really fast. Okay, so this for G30, right here. If I were to enter a buy trade here, right? Okay. Yep, so this area, we also have the 100% feed projection over here, which shows that at this swing low, which shows that this swing low is pretty significant and you shouldn't take it too lightly because with the combination of these factors, right, it shows that there is feed confluence here. All right, then you can and then you can actually take a position right where you feel that it's gonna go up. Okay, so for US 500, it's very, very simple. Very, very simple. Basically, price will come down to this 38.2% level and then go up. All right. And then your second support will be your 61.8% retracement level. And then you're buying the pullback as well. So this is one pullback level. This is another pullback level. Okay, so right, you can see right here that if price came down, right, retrace at least 50%. Okay. All right. Let's see this. Okay. All right. So let's move on. EURGPY. EURGPY. So Euro Pound Dollar. So this is very simple. Basically, that we have our 78.6% level, right? Along with this multi-swing high resistance level. Okay, then we also have the requirement whereby price needs to retrace at least 50%, right? So that's why we can see price is trying to reject this area and come down. Okay. Then lastly, we have this retracement levels, and then we have our 61.8% feed projection going on. Okay, so yeah. Okay, there's a possibility that price may react off this movement because you are not able to take maybe on the 1 hour time frame, you are able to do a good one right here. Okay, but then you can see that if let's say you wouldn't want to draw from this area, these highs, and then all the way down here because price will be cutting through, right? So the less cut, the better. Okay. All right. Let me see. All right, so let me just find maybe a couple more example, then in like maybe 10 more minutes, then we can end the webinar. Okay, so just bear with me for a little bit more. I know it may be slightly confusing. If you guys have any questions, just type it in the questions box, okay, so that I will know what to go through with you guys. Okay, so let's just take a minute to think about anything that you want to ask so that I can answer it as well, because usually sometimes people have a lot of misconception on Fibo, and sometimes Fibo the price has already closed, right? So for example, right here, we can see that price broke past, right? Supposedly going to form a head and shoulder pattern, but it broke through and went even higher. Okay, so that is something that you guys should take note of. All right. You guys have any pairs that you want me to go through with you? Feel free to send it in the Q&A box. Okay, so I'll be able to get to them. Okay, if you guys have no questions, then let me just move on. All right. Okay. Let me see where else I can show you guys. All right, so for here, let's say you are GBP, right? What we are expecting would be, right, price has already retraced 50%. Okay, so you shouldn't have to use, I think price is now reacting to 61.8. Yep, price is reacting to 61.8% fib retracement. Okay, this one should also be 61. All right, so what we're looking at for EUR GBP, ideally, for it to come down, right? Worst case scenario, right? You can see right here, the first support level, we have this negative 27.2% expansion level, right? Okay, so if let's say price does this, right? So once it completes this move, let's say price is here, then you can use your projection to see where price can go. So this high, this low, and this high. Okay, so if you have this tool right here, you can easily find something which is the 78.6% Fibo projection level. Okay, so once you have this, then you will be able to see where price could lead up to. Okay, so from here, same thing. Let's see, zigzag. Zigzag, right? Okay, so we will draw from this low. Oops. Okay, but yep, you can see right here that maybe this swing low is the one that is closest to this negative 27.2 expansion level, okay? But try not to squeeze your key levels onto your fib levels, because if you try to squeeze, right, then it will not be as effective, because your key levels should always come first. Your graphical key levels should always come first, and then followed by your FIB retracement levels. Okay, so this is just something that you guys can take note of. Okay, so what else can I cover with you guys? Let me see. Okay, so far, is everything okay? You guys have any questions? No questions? Okay. Because it may be if there's no question, I would maybe assume that everything is okay. And then if you guys are unclear of any explanation that I went through with you, just feel free to voice out and then let me know, and I can address it to you guys, okay? Because if not, um I would assume that you guys understand, right? So if you guys understand, maybe I can get a reaction. So like a thumbs up or type it down is fine too. Don't have to be shy because it's just us. Okay. Okay. All right. Let's see, 4 hours. Okay. Yep. So for example, right, sometimes when you're drawing FIB retracement levels, sometimes it's okay if price maybe cut through a little bit, because on you should refer to the daily, right? If the daily shows that it's a very nice movement, right, then you can draw it on the daily. You draw on the daily and then you can come to the H4 to see if it's okay. Means price it doesn't deviate like maybe too much here, then come down, cutting through, etc. Okay, so sometimes cutting through a little bit is fine, but not too much. Okay, so this is something that you guys can take note of also. All right, then next, what else can I cover with you? Okay, so sometimes you may be able to see projections, like for example here, here, and here. Bigger projections are always easier to see rather than the smaller ones. So let's take maybe Bitcoin as an example. Okay, sometimes you may not be able to see such movements. So uh let's see. Okay, sometimes rarely, but sometimes if I can't really see, I will use the line chart and then I'll pick these lows right here. Okay, and then I will draw to the highs over here and then to the lows. Okay, just to make sure that I'm not missing out the peaks, because on the line chart you can see that these are the max of the candlestick, right? Right, these areas. So you can see very nicely, right? If I use the freehand tool and draw right here, right here, and right here, right? And then it will line up very nicely with the body of the candle. Okay, so this is something that you guys maybe could use. Okay, let's see what else I can share with you guys. Okay, so just remember that your expansion levels, your negative 27.2% is the strongest is the stronger one compared to the negative 61.8. And also for the extension levels, the 127.2% extension level is stronger than the 161.8 extension level. Okay, and your 61.8% for your FIB retracement level is your golden ratio. So usually price tend to react a lot more there compared to other levels. Sometimes for example your 23.6% level is pretty weak. So sometimes I don't really rely on the 23.6% level. Okay, but more often it reacts to the 61.8 and 78.6. Okay, for the 50% is more or less it works pretty well also, but it works on maybe, let's say, pullback supports, so pullback support levels. So that's what I noticed. Okay, so yes, let me see. Yep. Yep, so this area is what I'm looking at for just an example, because we have Fibonacci confluence here. We have our 78.6% retracement level and 61.8% projection level, and then we are looking to buy this move upwards. Okay, so this is so you don't have to be afraid, you just have to be brave, and then you can be able to find optimal entries right here. Okay, all right, so yes, that's all for today's session, and I hope you guys actually learned something new and are able to understand retracements, projections, expansions, and extensions. Okay, so this is a whole crash course on Fibonacci itself, and I hope you guys are able to use it properly and use it well, so that you won't be able to find it misleading or whatnot. Okay, so thank you guys for tuning in to today's webinar, and I hope you guys have learned something new if you haven't. Okay, so thank you for being attentive, and I appreciate your time for listening to my webinar for today. Okay, so that's all I have for you guys. All right, take care, and I'll see you guys in the next webinar. Bye bye.